What's up, everybody? Welcome to the June 29th, 2026 IndiView Weekly Market Update. I'm Jeremy Bryan, and this is powered by IndiWealth. Last week, we're on a little bit of a hiatus as I took a little time, but we're going to get right back into those hot button market issues going on. So let's get started. So the first one I want to talk about is we're hearing a lot about volatile markets because we've had a lot of 1% movements, whether that's up or down, and we've had a lot of intraday movements up and down. I think there is some validity to that markets have been intra-volatile, especially in the AI and the chipset companies, which it tends to be the epicenter of the universe right now. But overall, it's not been that volatile. So I always look at volatility as the VIX index. And the VIX index, if you go back, we're at about 18 right now, which frankly, I mean, it's higher than it's been over, it was actually very low volatility over the past, for the most part in 2026. So we've risen off of the bottoms from there, but this is not what I would consider a volatile market at all. Usually volatility, when it really starts to spike, we get above 20 and sometimes even into that 30, 40 range. Now your 30, 40 range is very rare. It does, those tend to be very volatile markets where things are really happening, and it's usually a downslide. Usually don't get that level of volatility on the upside. But that can happen when people are really starting to get concerned and really start to, the panic starting to set in a little bit. I wouldn't say we're anywhere near that level at this point right now. And so while these 1% movements intraday up and down have had some impact on overall volatility, I don't think it's enough to really say that we're in an aggressively volatile market right now. And generally, still the backdrop still seems to want to push itself higher over time, given where we are from the perspective of, if we have Iran strikes that are coming to an end, which I'll get to here in a minute, and other things, and we're seeing some consumer sentiment rebounding. Again, we're still at high inflation, so that's a warning signal, but the general market trend seems to want to continue to push higher. And so we'll see what happens, but right now, volatility, from my opinion, is not something I'm overly concerned by as a precursor to a really dramatic decline in the markets. Turning to number two, I talked about it for a second here, is that oil is not reacting much to the recent strikes, which suggests that the market at least believes that this is a temporary blip. So the Strait of Hormuz is considered open. We'll see how open. I think things are flowing through there at this point now. But Iran and U.S. did trade attacks the other day. So there are still some elements of things that we need to watch there. Certainly the peace deal isn't completely brokered. We don't really know. We know some of the details. We don't know all the details. We know that the agreement as set forth does not seem to be a dramatic change from where we were prior. But from the market's perspective alone, I mean, oil is sub $70 right now. So from that, it suggests to me that at least at this point right now, the market is not pricing in any material escalation in the conflict that requires a recollapsing of the Strait of Hormuz, or a reclosing, and oil prices jumping up again. So we're not there right now. Again, this can always change in a heartbeat. Oil is dramatically volatile during some periods of time and not very volatile during others. Usually news events and things that we don't see coming are usually what ends up happening there. But as we see right now, and especially with what the market can see going on there, oil does not seem to be that we're back to that $100 range. There's no evidence of that at this point right now. Turning to number three, I wanted to talk about this just a little bit and take a back step of talking about the day-to-day market swings. But just, hearing more about this and reading more about it, I just thought it was very interesting, is that the new, the artificial intelligence companies, and the new technology, if you will, really has changed from what I would call the late 90s, the dot-com boom, to then the bust, and then the re-acceleration of technology going forward. It has really shifted in the amount of assets required to do these things. So if you think about what led the 2000 to, I would say even 2000 up to 2024, maybe even, was software companies. And, the Mag 7 has software companies in it, and it has internet-based companies, social media companies, these kinds of things. Well, what is the tying bind of all of those? Is they tended to be quite, compared to the revenues they generated, the assets they needed on their books with regard to physical equipment and things that they needed were relatively light compared to the revenue again and the cash flow it generated. And so as a result, the cash flows were immense for these companies. And I think that was what the biggest wave was, is these companies just threw off so much cash because they would generate revenue. They would have to pay their employees. Obviously, they have to do other things, but they didn't have heavy capital expenditures beforehand, which allowed them to get a lot of free cash flow, which allowed them to do a lot of different things, whether that was buy back more stock, buy other companies, grow their business, do the things they needed to do with a bunch of free cash that they were getting at really good growth rates going forward. We're in a different mode at this point now, is that the artificial intelligence companies as of now are very asset heavy. You've seen them have to go to market. SpaceX just came in with the largest IPO over time because they're going to be spending aggressively. I mean, some of it was a liquidation event, but some of it was to also generate some capital to then go and buy the things and the assets they need to buy. Google has gone out to the public markets, and you've seen a lot of free cash flow from these companies erode immensely. Now, part of that is the quote unquote space race, right? Is that we're going to overspend right now because we need to make sure that our market share sustains so that we sustain going forward in what the next generation is. I believe that absolutely is part of this going on in this process right now. That's why you've seen chipset companies go up 200, 500, 1,000%. Because people are just have insatiable demand for assets that they can use to then deploy artificial intelligence in whatever way, shape, or form that they feel is best. So in that regard, most of the bigger companies now in the S&P 500 that are artificial intelligence focused are very asset heavy and have less free cash flow. In my opinion, as a result of that, and again, if you believe this is temporary, then maybe it doesn't correlate. But usually lower free cash flow companies have historically carried lower multiples over longer periods of time. That has broken here, is that asset heavy companies are trading at very high premium valuations. And so I don't know if this sustains over a longer period, or if we get back to, if we look at this period in 20, 25 years and saying, man, we were paying that for that level of cash flow. Or we were paying that for that company who had to buy all these assets, and then, in an uncertain market. I don't know what we'll look back at 20 years and doing. I don't think the valuations for these companies in 20 years will be as high as they are now. In certain regards, some of the more established ones will be. But some of these high flyers that have really, really shot up are valuations now that especially if you're asset heavy, I just don't think last over a longer period of time, unless we buck 100 years of market trends, which is absolutely possible. Things change all the time. But I just thought it was interesting from that perspective, is that the new generation of what we're considering going forward is much more asset heavy than the things that we thought were the greatest things in the world the last time. So keep an eye on that. Again, not much to do from an investment perspective. Again, understand that we are in a super cycle. There's no question about that right now. And when that starts to turn over, will people go back to what was happening in the prior 100 years? Will the companies adjust? And that's entirely possible as well. So it's something to just keep an eye on. Not much of an investable change perspective at this point right now. Turning to number 4 on the personal side, I thought this was worth talking about, is that there's 2 outdoor survival shows that, Outlast is on Netflix and Alone is on the History Channel. I always purchase it, so I don't know what it is. If you know me, I'm a huge fan of Alone. It's one of my favorite shows out there. I watch every season. And if you don't know, it's basically a survivalist show. It's about the most simple presence ever. That they drop 10 people into the middle of nowhere, and whoever lasts the longest wins. That's really the premise of the show. So they get dropped off with 9 supplies that they pick, and they're out there alone, and they can tap out whenever they so choose. The last one there wins $500,000 typically. Outlast is a little different. Outlast is a little bit more of, it's a survivalist game, but it's a team-based game. And there's more of the, what I would call, the challenges of a survivor kind of thing like that. So it's more of a survivor-ish type of show. When I'm doing those, as you can probably tell, I'm much more of the Alone fan versus the Outlast fan. I've watched the seasons of Outlast. It's entertaining, but it's entertaining in a different way. It's entertaining in team dynamics. There's a lot more what I would call, predefined things to look at. Whereas, the Alone is just, can they survive? And there's really good seasons where there's a bunch of excellent people really doing, really surviving and really thriving. And then there were seasons like last season, which was, I think, ended in like 34 days. And they all really, really struggled. So it's a very interesting show. It's very fun. I enjoy Alone. I would take Alone well before Outlast. And frankly, I would take Alone before Survivor. So I think Alone is the top of the survivalist type of shows out there. So that's all we have this week. Tune in next week. We'll have our next hot button topics. But until then, thank you very much. Take care.